Hello, everybody. Welcome to my talk. I have read chapter 6 now, and it's all about bonds can be risky too. And let me just read you this little caption here. Of all these dangers to bonds, the most serious are an increase in the actual or expected rate of inflation and a change in government fiscal and monetary policies. So that is what you want to look out for. But there are several that I read that were very interesting. I really enjoy history, and this is a little bit of history of bonds and what's happened here with bonds. But one of the risks of buying bonds from companies, it's a leverage buyout risk, and it's called LBO, or the acronym LBO. So downgrade in the quality rating. That what it is a downgrade on the quality rating of a corporation's bonds stemming from a leverage buyout can result in a huge loss for the company's bondholders. An LBO is a process by which a company is purchased using borrowed funds collateralized by the target company's assets. So here comes the story. There's two stories. One is from Nabisco. You know, the Oreo cookies and all that good stuff that we buy and love. So back in 1988, there was a takeover. I can't find the name. So the takeover was won by Kravitz Roberts, but there was L. Ross Johnson was the CEO of Nabisco and wanted to buy the company for himself. So he made a big bid, and which was the largest at the time, to get that to buy it. Kravitz and Company for a whopping. So it was sold for $29.6 billion by Kravitz. It was bought by Kravitz, but it all started because John L. Ross Johnson, the CEO of Nabisco, wanted to buy it, and everybody found out about it, and they said, well, they're selling, so let's buy. So Henry Kravitz, whom was greedy at the time, wanted to take that away from Mr. Johnson. So he did a big borrow of money so he could be the winner, be able to buy it. And what happened is that because of all the money he borrowed, you know, like I had in a previous chapter, they have like A bonds and then AA bonds and then BAA bonds. So this was there was a top of the chart, Nabisco company. And because of all the stuff he borrowed and you know, all the fighting and bidding, and you know, it actually says here, by the time the dust settled or the blood dried, because you know he pretty much took it away from Mr. Johnson over here, whichever description you prefer. Once the takeover was completed, RJR Nabisco's previously A-rated bond had been downgraded in quality virtually overnight into those Michael Milken specials called junk bonds, costing RJ Nabisco's bondholders King Kong size losses in the value of their investment. So everybody who invested, thought that because it was a big company and because they had spent so much money in it, would incur more profit for them. But in turn, because all the money the company borrowed, their their investment value like plummeted, so they lost instead of winning. So that's what a LBO um, loss would be. And then the other one that they have was Texaco versus Pennzoil. So it starts. Texaco was like top of the line back in the day. It had everything. It had uh, oil here and oil, in the Middle East, and somehow the government changed where they couldn't grab oil from other places, like Buy American and whatever. So they were losing, and their sources of oil here were diminishing. So they were looking to buy something um, to help them here. Oh, their Saudi Arabia. That's where they would buy their oil from or have their oil from. So anyway, they found it was called Getty Oil Company. So they wanted to buy Getty Oil Company, so they had oil again, so they could be big again, because they weren't at the top anymore. They were going down. And Getty had already sold to Pennzoil, who also needed, everybody was running out, so they were trying to get oil from somewhere. So Getty had already like signed paperwork and everything with Pennzoil, and they said, not thinking that they would get another bidder, they said, well, we're tied with Pennzoil unless somebody comes that offers a little bit more. And Texas read that and offered more. So Getty went ahead and said, okay, here, I'll sell it to you. So Texaco won the bid. And again, there was bloodshed and everything, because it was they pretty much took it from Pennzoil. So they had it and everything, and then Pennzoil, they were mad, so they sued for $10 billion, and Texaco tried to do, go into bankruptcy or whatever, so they wouldn't have to pay that, but they weren't able to, and so they ended up like trying to negotiate with Pennzoil, and they did. They negotiated it down to, they still had to pay, I think it was $3 billion. Yeah. So it was a whopping, but considerably less whopping $3 billion, a decision that enabled Texaco to emerge from bankruptcy by the end of the decade and begin bettering things for itself and its investors. The company has survived handsomely. So, I mean, we still have Texaco, but it took a while for bondholders and buyers to once again trust their card to the man who wears the star. So, but because all the money they had to borrow again, like the other company, they went down in value from top of the line to downgrade because of all the money they lost. So the bondholders lost money there too, because they had let them borrow the money, but now they were not A, now they were like at the low, C type of bond, which lowers the amount of money the bondholders get. So don't get stuck on an LBO. And then the other risk would be bankruptcy and default. And the stories behind that would be Chrysler Corporation. So it's these are really cool, and I'm sure if you read the book, it's more interesting than me telling you. But so Chrysler was again one of the big three, up at the top, and Walter leadership by 1928 it was able to acquire Dodge and introduce two more product lines, the economy. Okay, so this is what happened with Chrysler. So Chrysler was not making the right car at the right time. So they were at the top with Ford and Chevy, I believe. And what happened is that people at that time were buying cars that were gas guzzlers, like they wanted big cars and show off. So at that point, Chrysler decided to make the compact economic cars, and nobody was buying them because they wanted to show off, get the big cars. And so later, like when they saw what was happening, they said, okay, let's make the big cars and sell the big cars. But it was at the end of time, so they started making the big gas guzzlers, and yes, people started buying a little bit, but then I guess it's when the economy died and everything. So then people started wanting to buy economic cars that didn't waste a lot of gas and everything. And Chrysler already had them, but they were late to get on the bandwagon. So they kept selling their gas guzzlers. That's what they had to offer, and they didn't want to spend any more money making anything else. So they kept that, where the other companies started making the economic cars and doing well. So they were just not in sync with what people needed at any time. And so at the end, well, here it goes. With the American economy deep in recession by the mid 1980s, due to rising interest rates and worsening inflation, Iacocca. Okay, so Iacocca was the new CEO of the company, and he grabbed the company when the company was like dying. So Iacocca, remember that name, a smart guy. So he started making, now selling the economic compact cars, and but they were so down at the end that he started doing like commercials. What it says something here about the Lee Iacocca Maverick, and Walters Chrysler's tradition came to the rescue along with Uncle Sam. Iacocca was the former president of Ford Motors, where he had spearheaded development of popular Mustang. He actually had joined the fray 2 years earlier when Ford fired him, and he jumped aboard the crumbling Chrysler as a new CEO. Economic woes and election year by allowing Chrysler, a major defense contractor with 100 employees, to go under. So he wasn't gonna let Chrysler. So he appealed to the Carter administration for help. He went to the government to get help, and they did help him, and by downsizing. So he accomplished that so he got help from the government, and he also downsized operations, closing plants, successfully prevailing upon the labor union to go along with wage cuts and layoffs, and changing the company's product line focus from gas guzzlers to smaller, more fuel efficient cars. Here it is. Iacocca became the most visible and well-known CEO in history up to that time, as he personally huckstered Chrysler's new line of better mileage K cars to the public in expensive prime time. So he was making a lot of commercials and going, out of his way to help Chrysler, and he eventually did. But the problem and why and he helped it from but until Uncle Sam stepped into the Bell Chrysler out, investors who had bought the company's bonds back in 1973 were earning negative annual current interest of minus 3.1%, 8% coupon, minus 9.3% average inflation. And those who panicked and sold their bonds before the mid 1980 bailout, lost 72% of their principal. So a lot of times, when you are in problems, stay there, because if you sell, you lose everything. If you stay and let it drive with it, you might get your gains back. But anyway, I thought that was a cool one. But that's they were about to go into bankruptcy until Iacocca went and moved that thing on. Then another one, I don't remember that that store. It's W.T. Grant, but that was in 1906. That might be why I don't remember. But same thing happened. Like, they were behind. They were a big top of the line, who is in right now? I guess Target, Kohl's right now. They were a big company, strong, and then, but they were in the city. And then, the suburbs started growing at that time, and a lot of retail stores like that started going to the suburbs where people were moving to. And W.T. Grant stayed, so they didn't want to move because they were already doing good. But then all those people were taking, or not all those people, all those stores were taking all the profits from the people that moved to the suburbs. So so they were losing a lot of money, a lot of clients. And so years when they were not doing too well, they decided, okay, well, let's now go and to the suburbs and put stores there so we could catch up. Well, when they decided to do that, all the good places were taken, so they were getting bad locations and more expensive sometimes because there wasn't any options. So they would spend more money for bad locations, and that didn't work for them either. So then they had to close out, and then they owed a lot of money to the people that would sell them the stuff that they wanted to sell, and some of them wouldn't sell to them anymore, and it was a big problem. So they had to go bankrupt, and it's all that, not knowing when to do the things, not wanting to follow the trend, that made them plummet down. And unlike Chrysler, W.T. Grant did not make it. They ended up bankrupt and never came back from that. And as you know, the bondholders lost in that situation too, because of course from being up here, you go down, the money doesn't come back. So they also were trying to get loans. That's where the bondholders came in. And so it says here, so Grant Sales did a bungee jump without the cord. The volume of unsold inventory mounted, and the volume of customers' credit sales that went unpaid and uncollected increased as well. In a last gasp to stretch the flow of its corporate blood, which was refusing to congeal, the chain shuttered the windows on 126 of its 1,194 outlets. So the impact on bondholders was this. At the bond market bottom in 1974, the bonds that investors had bought back in 1962 were trading as low as $20. The following year, just before the company went bankrupt, they sunk to $15. During that 13-year period between 1964 1962 and 1975, bondholders who bought those bonds were being paid 4.75% annually when inflation averaged 4.5%, a meager 0.25% return in real current interest. Then they lost almost all of their principal when W.T. Grant went belly up. And then there's, last but not least, high-profile local government bankruptcies. So New York City went bankrupt in 1975. So the people that bought bonds for the city to help out lost money there. I'm gonna go fast because I'm at 20 minutes now. And then the one closer to me, I live in Chino, and Orange County is right up the hill. Orange County fiscal crisis. They were about to go bankrupt too, and what the story says is, even though it's a rich or very wealthy county, Orange County, it still could have problems. And I forget what the problem was. 1994 resulted in a huge 1.7 billion loss in the market value of the county's investment portfolio. As the situation became clear to the portfolio's pools of investors participants, which included 200 government entities in and out of the county, as well as note and bondholders, many of them tried to withdraw their funds. This created a liquidity crisis the portfolio couldn't withstand. Orange County was forced to file for Chapter 9 protection under the Federal Bankruptcy Code. So, a lot of bondholders lost money there too. So, at the end, avoiding default risk, this can be done in a very simple way by concentrating your bond portfolio in U.S. Treasuries. The bond market selected my new strategy points to as the investment of choice, especially for the average investor. That would be us. We are the average investor. And the way for us to go is U.S. Treasury bonds. And it goes on to say why, but we know why because we read it in other in other chapters. But interest rates and inflation are the riskiest thing to bonds, and we saw there's other bonds, not just T bonds and government bonds. There's the cities like Orange County and New York City, and there's companies that also sell you bonds, but those are the risks, and those were big companies that we talked about, and rich counties. So it's risky out there, but again, the book says that T-bonds is the way to go, especially for us average investors. So that's what I leave you with, and I hope I made it interesting, because it was interesting to me. I really enjoyed reading this because it's like, oh my god, it's like a novella, like a soap opera. Like, what happened and why did they do that and who won, and what happened at the end. If you do bad stuff, you pay for it at the end. And that's what happened to these people, or when you are not willing to change your mind, like the Chrysler or that other company, you lose out. And what's happening, you have to keep on top of it. Read, write, learn, watch the news, keep keep your mind knowledgeable and sophisticated. Oh my god, a bee just came in my yes. Okay, I'm gonna leave you with that because I'm gonna try and get rid of that bee. Oh, it's left. Give me a minute. Sorry about that. It went out the door and I just closed the door. But anyway, I hope you enjoyed it. I enjoyed talking about it. I enjoyed reading it. And I'll see you next week with, let's see what we have next week. Chapter 7 is Treasury Bills, the Ultimate Safe Haven. Treasury Bills. Safe Haven. That's what we're going to talk about next week. Anyway, bye. Thank you for listening to my talk. I hope you enjoyed it. I surely did.